Done. See, we have what we have done with respect to investment property. When we are talking about the investment property, what is the rules of investment property? The rule says that owner-occupied property is excluded from the definition of investment property. Investment property is what is related to the business, but it is going to be generating the rent. Okay. Now, in the investment property, the concept is you have the cost model and fair value model. In the property, plant and equipment, we have cost model and revaluation model. Is there in the property and plant and equipment? Is there what is the fair value? What is the rules of fair value model? We have to fair value at the end of the year. The gain and loss should be shown directly in the profit and loss account, and we should not charge any depreciation in the terms of fair value. Cost model, what we have done in the property, plant and equipment, same thing we have to work it out with respect to cost model. In the cost model, we will calculate depreciation. In the fair value model, we will not calculate depreciation. Fine. Now, coming back to this, what they say, if the asset is transferred from see what will happen, you will have so many issues will be there. If the asset is transferred from property, plant to when you are transferring one asset, today date is 23rd. March. See, when the asset is transferred from property, plant and equipment, is it right? Now, sometimes what will happen, you are transferring from property, plant investment to investment property. In the meantime, sometimes I told you the issues will be having like this. You will have a property of 5 floors, 1, 2, 3, 4, 5, 6. Is that you are using it for your business purpose? Is that you are using it for business purpose? Now, what will happen? Due to some reasons, you are transferring this investment property to this business property to the investment property. And sometimes what will happen, you are transferring from the investment property to the business property. In the question, it will be clear very clearly. Is that first what you have to do, if an asset is transferred from property, plant, equipment to investment property, and the fair value model for investment property should be used. In that case, whatever the value that exists on the date, that has to be used. What is the rule says? The asset must first be revalued. You have to revalue the asset. Is that you will have some, if assume we are taking into consideration of a value of assets to 10,000 and it is transferred to investment property. Is that first you have to revalue this one. Is that you have to revalue this one. You are revaluing this one and saying that assume you are taking it on a higher side. You are having how much? You are having a revaluation of 11,000. How much is the gain you are getting? You are getting a gain of 1,000. That 1,000, the asset must first be revalued. You will have a revaluation surplus will be there. How much is the revaluation surplus? Revaluation surplus of 1,000. Is that 11,000 minus 10,000, revaluation surplus will 1,000. And then transfer it into a investment property at fair value. First you have to revalue it. Then once you have revaluing it, what we have to do? You have to transfer it to the investment property at what value? You have to transfer it into at the fair value. If cost model is used for investment properties, what is the cost model? Cost model is normally cost minus less depreciation. The investment, the asset is transferred to investment property at the current carrying amount. Is that at the current carrying amount? You know the carrying amount. What is the rule of carrying amount? Carrying amount is nothing but cost minus accumulated depreciation. Is that cost minus and continues to be depreciated? Means very simple. If it is transferred as per the revaluation model, first you have to calculate the revaluation and subsequently you have to transfer to the investment property. If it is as per the cost model, we have to take the current carrying amount. Now, what is the other option? If the asset is transferred from investment property to property and plant. See what is happening in the first case, we are transferring from property, plant and equipment to investment property. In the second case, we are converting from property, investment property to property, plant and equipment. Is it? First one is we are converting property in PPE to, this is the first option. Is it that? This is the first option. This is the option where it is going to be here. Is it? The second option is yes, Mazin.
Yeah, doctor.
What happened?
I don't know. Suddenly it's
okay, no problem.
stuck. Yeah.
No problem. Okay.
All right.
No.
All right.
Fine. Now, what happens? See, the two things are there in simple words. Okay. In simple words, there are two things are there. First, you are converting from property, plant and equipment to investment property. Second option is what? Second option, you are converting investment property to property, plant and equipment. What is the rule of investment property to property and the fair value model? If fair value model is a revalue the property as per I. First you have to do as per the IAS 40. First you have to make revaluation as per IAS 40. Whatever the gain and loss you are going to have, the rule says that whenever we are doing gain and loss on IAS 40, we have to show in profit and loss account. Is that taking the gain or loss to the statement of profit and loss account, and then you have to transfer to property, plant and equipment. And then you have to transfer to property. Just hold it. Once we are doing the question, we will understand. If the cost model is used for investment property, cost model is simple. Cost model, we don't have anything. Of course, fair value model is also simple. I am not saying. Fair value model is nothing but, see, when you are transferring investment property, we will value it. Is that we will value it, and whatever the fair value is there, we convert it into fair value. If cost model is there, what simply we are taking what? We are simply taking the current carrying amount. Is that current carrying amount is nothing but the cost minus depreciation, accumulated depreciation. Okay. Again, just for simple understanding, I will say that if we are doing property and plant and equipment, whenever there is a revaluation, you have to take into where you have to creating a revaluation surplus in equity. When you say it is revaluation surplus in equity, you have to go through other comprehensive income. Here, in the second case, if you are doing revaluation with property, plant and investment property. We are not going to take we are not going to route through the equity. We are taking it to through whom? Any profit, we will show profit and loss, we will show in profit and loss account. Okay? Any profit or loss we show in the profit and loss account. Come back. Just now we will have more clarity here. Take the things. Kyle company purchased an investment property some years ago. Okay? Kyle company has purchased investment property some years ago and carries it under fair value model. Yeah, they have purchased investment property and using the fair value. At January 1st, at January 1st, the property had a fair value in the financial statements of how much? 12 million. On July 1st, this January 1st, 2001, there is a fair value is how much? Fair value is 12 million. Next, on 1st July, okay, on 1st July 2001, they want to convert this investment property. I will write IAS 40, okay. IAS 40 is investment property. They want to convert this investment property into a property and use it for the business. When you are using it for the business, IAS 16. As at that day, the fair value is how much? The fair value is 14 million and the remaining life is how much? Fair value is 14 years. Sorry, fair value is how much? Fair value is 14 million and the remaining life is how much? 14 years. What they are asking, what amount should be recorded in the Kyle statement of profit and loss. For the year ended how much? For the year ended 31st December 2001. They are converting the investment property, they are converting the investment property into property, plant and equipment. And they are using which model? They are using fair value model. Is that? They are using which model? They are using fair value model. Now, how much? If they are using the fair value model, what we should be do? What we have to do? What we have to do? What we are doing? See the things. They are using this. They are using this one. Is it right? They are transferring investment property to. They are transferring investment property to property, plant and equipment. And they are using which model? They are using the fair value model. First, you have to revalue at the fair value. How much is the revaluation at the fair value? How much is the gain we will get? How much is the gain we are going to get? Revaluation gain.
2 million.
Is it right? How much revaluation? How much is the, see the thing. Investment property, is it right? Investment property, move to property, plant and equipment for the business. Which method they are using? Fair value method. Is it right? First, what we have to do? We have to calculate revalue the property first as per IAS 40, taking the gain or loss to statement of profit. What is the revaluation? What is the revaluation? Revaluation at the date the asset had a fair value of how much? At the revaluation is how much? It is how much? 14 million. Okay, revaluation amount is how much? 14 million. As on date, stated cost is how much? As on date, stated cost Stated cost is how much? Stated cost is 12 million. Is that stated cost is how much? 12 million. Revaluation gain will be how much? This is the revaluation gain. We are going to take it where? We are going to take it to profit or loss account. Is that? We have to take it to a top. Now they are transferring it to what? They are transferring it to property, plant and equipment. This is the step 1. This is the step 1. Fine. This is the step 1. Now what is the step 2? Step 2 is they are converting to property, plant and equipment. When they are converting to property, plant and equipment, when they are converting to property on 1st of July 2001, how much is there? It is 14 million. Is it right? It is 14 million. Life is how much? Life is 14 years. Is it right? Life is 14 years. Now, what you have to do? You have to calculate the carrying amount. Is it right? You have to calculate the carrying amount. Carrying amount as on 31st December 2001. Okay. Now, value at 1/7/2001 is how much? 14 million. Because it is a property, plant and equipment. Okay, where it is property, plant and equipment. We have to calculate the depreciation. How much is the depreciation? 14 million. Is it right? 14 million divided by 14 years. Is it right? Times 6/12. Are you understanding? Because we have to take depreciation when? We have to take depreciation from 1/7/2001 to 31/12/2001. Only for how many months? 6 months. How much you'll get?
500,000.
500,000. Is it? How much you'll get? 0.5 million. Okay. What is the carrying amount? Carrying amount is 13.5 million. Is it okay? Is it okay?
Okay.
Fine. So
Yeah.
Maryam, Mazin and Hussein. Right? It's not, see, it gives us, we think it is, wait, it is same. First, what you have to do? We have to revalue it. We will get the revaluation gain and profit and loss account. Subsequently, property and plant and equipment, again we have to start with the revalued amount, calculate depreciation for 6 months, and subsequently we have to show the carrying amount as on 31st/12/2001. Now, see the things. Is that during the year, can I start 10?
Yes.
During the year 30th September, Hudson built, see, always keep it in mind, divide the sentence. Okay. During the year 30th September 2003, Hudson built a new mining facility to take advantage of new laws. Okay, they have new laws on share. The construction of the facility cost 10 million, and to fund this, Hudson took out, they have taken loan. How much? 6% loan, which is not, will not be repaid until 2006. They have taken the loan, borrowing cost will come. Okay, they have taken the loan, borrowing cost will come. The see, when they have started, see the thing, they during the year to 31st 30th September 2003. Build a new mining facility. The construction cost and the 10 million fund, they have taken the loan. When they have taken the loan, they have taken the loan on 1st October 2002. Loan taken. How much they have taken the loan? 10 million. Okay, at the 6%. 10 million, 6%. Okay, it will be paid for till 2006. Okay, the 6% interest was paid on 30th September. They have paid interest on 30th September. Construction work began 1st October. The moment construction work began, we have to take interest. Okay, this is what borrowing cost rule says. The construction work began on 1st October and the work was completed on 31st August 2003. As not all funds were required immediately, see the thing, they have invested 3 million in the loan, means you have interest payable as well as interest receivables. Okay, they have invested, just remember IS 23 borrowing cost. Okay, as not all funds were required immediately, they have invested 3 million in 4% bonds from 1st October till 31st December. What is the duration? What is the duration? October, November, December, January. Okay, how many months? 4 months. They have made investments for how much? 4 months. Mining commenced on 1st September and it will continue for next 10 years. Okay, as a condition, see, as a condition to allow to construct the facility, Hudson required by law to dismantle. Okay, means dismantling cost is there. Again, you have to take present value. Okay, 1st October 2003, estimated how much? 3 million. For this, you have to, if it is required, you have to take present value. Okay, you have to take present value always. As the equipment is specialized, Hudson invested significant resources, recruitment and training. They have spent 600,000 in this process till 30th September. We should take recruitment and training expenses. Yes or no? We have to take recruitment expenses. Yes or no?
No.
We should not take. Okay, good. Believing to be worthwhile, and it answered that the most employees will remain in the project for 10 years. What is the cost of capital? 6%. It is like, it is a complete revision what we have done in this lecture. Complete revision. Okay. Now, what you have to do? First, you should know what is the harm. They have taken the loan. Is it right? They have taken the loan amount also. Fine. I will put like this. Step 1. Is that step 1? Okay. Now, how much they have taken? When they have taken the loan? When they have taken the loan?
1st October.
1st October. Is it right? When they have taken the loan? 1st October. Construction began and completed 1st October. And when it has been completed, they have taken the loan on 1st October and they have completed when? They have completed on 31st August. Okay, they have completed on 31st August. What is the rule I said? When we have taken, now you understand, they have taken the loan on 31st October and completed on 1st August. Is it right? The end was, first 2 and they have completed on 1st August, 31st August. How many months are there here? How many months are there here?
11 months.
11 months. Okay, 11 months only interest. The moment it is completed, we should not calculate interest. If the moment it starts construction, you have to calculate interest. The moment we complete the construction, we have to stop the interest. Means interest for how many months we have to calculate? We have to calculate interest for how many months? 11 months. Is it? Now, interest payable. Is it right? Interest payable. For how many months? 11 months. Okay, interest payable for 11 months. What is the loan amount is there? Loan amount is 10 million. Loan amount is 10 million at the rate of 6%. How many months? 11 months. How much you will get? Quick. How much you will get? Yes, Hussein.
550.
550. Okay. Now, fine. From this, they have invested also. Is it right? Interest income. They have the interest income also is there. Interest income. How much they have? We have done here. For how many months? 4 months. Okay. They have invested. As not, they have invested this one. Okay. Investment income. How much they have invested? They have invested 3 million. Okay, they have invested 3 million. They have invested 3 million at the rate of 4% for how many months? 4 months. How much you will get? How much you will get? Margin.
400.
How much?
400. 0.04.
0.04. 0.04 is nothing but 40. 3 million. 3 million times 4% into 4 by 12. Means we have taken this in thousands. We have taken full amount. Is it right? Now, what is the amount is there? You have 510. Is it right? This is the amount to be capitalized. Here, this is the amount to be capitalized. Now, see the things. They have, is that this much amount? Actually, it is for 12 months. Is that? Now, if you take that into consideration, how we have to write? Okay, how we have to write? This amount has to be capitalized. Is that? This amount has to be capitalized. How much? 550,000. Plus, there is again for 1 month. Is it right? It has been completed on 31st August. They are paying this again. They are paying some interest here. Is it right? They are paying interest here. Is that? This is going to be expensed. Okay? This is going to be expensed. Profit and loss account. Is that? Amount to be expensed. Is it? Amount to be expensed. How much amount to be expensed? See the things. 10 million times 6% times 1 by 12. Is it right? 1 by 12. How much is there? Only for what? Only for September. Okay? Only for September. How much is there? It comes to how much? It comes to 50,000. Are you understanding? The moment we have completed, the moment this we are going to show where? This we are going to show it in the balance sheet. We will add to where? We add to IAS 16. Okay? Property, plant and equipment. And this amount we are showing in the profit and loss account. Is that? This amount we are going to show in the profit and loss account. Is that? This is the treatment of expense. Next. Are you clear about this?
Yes.
Now, second point, step. What is the second step? They say that I have mentioned here, okay, present value. Is that they are dismantling this, okay? Whenever there is, see, you are constructing something, you are constructing for that, very simple. Before you start construction, you will put some small porta cabin. Is that you will put some small porta cabin, you will create some temporary road, all the things will be done. Once construction is over, then you have to remove that, okay, you have to remove that. That is also the cost, is it? That is also the cost. How much is the cost they are going to spend on that? They are going to spend on, for how much? 3 million, okay, they are spending it for how much? 3 million. Again, this is going to be how much? This is going to be for 11 months only, okay. This is going after 11 months. Construction will be how much? Dismantling cost, is that dismantling cost. This is only for how many months? 11 months only, okay, 11 months only. What is the, see, what, how much is the cost? Cost is 3 million, is it right? Time is how much? It is for 11 months, is it right? 11 months. In order to calculate present value, okay, R is how much? Rate of the discount, cost of capital is how much? Cost of capital is 6%. Now you have to calculate present value of dismantling, is it right? C divided by 1 plus R to the power of T. Okay, C divided by 1 plus R to the power of T. C is how much? C is 3 million. Okay, 3 is 3 million. Fine. 1 plus R, how much? 1.06. Is it right? 1.06 into how much it is? Into for 11 months. Calculate how much you will get.
Doctor, should be 0.11.
0.11.
The period, right? Because it's least 1 year. And also the interest rate will be divided to 12 months.
Uh, 3 divided by 1.06 to the power of 11. Yeah, tell me.
2.99.
Huh?
2.99.
2.99. 2.99.
Because this interest rate will be for 1 year. You should divide it to 12 months.
No, 1 minute, 1 minute, 1 minute. 1 minute. Hudson invested, see the things. Hudson invested 3 million. Okay, fine. Mining commenced, fine. As the condition, Hudson required by law to dismantle it on 1st October 2003. 2003. This will cost how much? It will cost 3 million. as the 1 minute, as it will 3 million. As the equipment is special investment significant, it will, fine, this is not required, okay. The construction of facility 10 million, which the 6% interest, construction work on 1st October, completed on 31st August. Not all funds are required, and mining commenced on 1st September and is expected to continue for 10 years. As a condition required to dismantle it on 10, Hudson estimated that this will cost a further 3 million. Now, yeah, it is. It is not 2.99, okay? It is not 2.9. 1 minute. It is dismantling cost. Dismantling cost, okay? T. Time, okay? T. I will tell you how it is, what is the amount of T. They said that when the construction is starting, the construction is going to be started building take advantage the fund which will be repaid. Construction work begins when the construction work begins on 1st October 2002. It will be completed by 31st August 2003. Okay, 31st August 2003. 31st August 2003. And as not all funds were required immediately. First, okay, now, 31st August 2003, good. They said that mining commenced on 1st September. Mining commenced on 1st September 2003, and it will be expected to continue for how many years? To continue for 10 years. Okay, fine. Mining is going to be there. Now what happens? We have a dismantling cost. Okay, we have a dismantling cost. Dismantling cost, total life will be how much? Total life will be how much? If you take into consideration the total life will be how much? From 1st October 2002 till 31st August, it is commencing from 1st September, and it will be there for next 10 years. Is it right? It will be there for next 10 years. Means this is almost 11 months. Is that from here, if you take into consideration, it is almost 11. 11 plus 10 years, it is like 1 year plus another 10 years. It will be how much? It will be 11 years. Now, the reason why we are doing this is, when you are calculating the dismantling cost, the dismantling cost will be recovered over a period of 11 years. Is that after 11 years? It says very clearly, as a condition of being allowed the construction facility, the required lot to dismantle of when how much? You have to dismantle by the 1st October 2003. Okay, we have to dismantle on 1st October 2003. But the project life is going to be how much? The project life is going to be for next 10 years. Is that? The project life is going to be continued for how many years? 10 years. Is that? Means the total life is going to be how much? The total life is going to be 11 years. The dismantling cost, we are not deducting the dismantle cost immediately. Is it right? We are not going, when we are using when the project life is 10 years, we distribute, is it right? We distribute this for next 1 plus 10. Okay, one year, that is the initial year, plus 10 years. We are dismantling cost will be distributed for 11 years. Is that? Sorry, incidentally I put 11 months. Okay, incidentally I have put 11 months. It is not 11 months. It is how many years? 11 years. Is that? See, that we are dismantling it within 1 year. Okay, we are removing it within 1 year. But what will happen? This cost will be proportionately distributed. See, we are using what? We are using the matching concept. We are using the matching concept. We are matching the revenue with the expenses. That we are matching the revenue with the expenses. That is the reason when you are doing it, we will take how many years? We will take 11 years. Is it clear to you? If it not, let me know. Is it clear to you? Yes or no? I can understand where you need more explanation, where you need less explanation. Yes or no?
Here, doctor. Until here, it's all right.
Until here, it is all right. Okay. See, again I say, see, you have dismantled. It is a 3 million. It is not a small amount. Is it right? It is not a small amount. It is 3 million. You take the present value. You distribute the present value over a period of the entire project life. Is that? You have to distribute to the entire project life. How much is there? 3 million divided by 1.06. Cost of capital is 0.6. This is 11 years. Okay. This is 11 years. How much you will get?
1.58.
1.58 million. Okay, 1.58. If you divide it to, it comes to how much? 1,580,363. Okay, this is the thing. Now, what you have to do, see, dismantling cost we are doing. This is the present value of dismantling cost. This is the present value of 1,580,363.
Doctor, can you explain again present value?
Yes, that's what I'm asking.
Yeah.
I know. Okay, I know the thing.
Yeah.
Is it right? See the thing. Just I will take separately. Is it right? Just I will take separately. Okay. I don't want to mix. What is there? We have started on 1st 10/2002. Is it right? 1st 10/2000. We have completed on 31st August 2003. Okay. What they say, it will be from 1st October 2003. It will be they will take how many years? It will take 10 years to have the project. Okay. This is the first thing. Next, what they say, there is a dismantling cost. There is a dismantling cost of 3 million. Okay, there is a dismantling cost of, means you have to remove it. Now, instantly, if you are removing 3 million from 1 year, what will happen? It will have impact. Okay, it will have impact on your project type. Now, apart from that, they should also calculate interest amount. Is that they should also calculate interest amount. Now, for dismantling cost, how much is there from here to here? There from here to here 1 year, and from here to here how many years? It is 10 years. Is that? Now, when you are doing the present value, is that this is C, cash flow. T is how much? T is how much? T is 11 years. Total number of years are 11 years. Present value is nothing but C divided by 1 plus R to the power of T. Is it? R is how much? R is 0.06%. Is it? R is 0.06%. How much is there? 3 million. Is it? 3 million divided by 1.06 to the power of 11. 11 years. Is it? It comes to 1.58. Okay, 1.580, whatever it is. Now, are you clear about this?
Yeah, clear now.
Now what they say, see the things. They say that they will have how much is the 1.58363? Is it at 363? See, they have to calculate on this. Interest will be there. Is it right? Interest amount will be there. How much you have to calculate interest amount per year? Is it right? Interest amount. How much is the interest amount? Interest amount is at the rate of how much? At the rate of 6%. Is it right? At the rate of 6%. 1580363. It comes to how much? One five eight zero three 1580363 times 6%. It comes to how much? 94822. Is it right? 94822.
Yeah, that's correct.
Are you clear about this? Now what is happening? Three things are there. Okay, are you clear about this?
Yes.
Okay. Now, step 1, what we have done, again I am telling you. Step 1, we have taken interest payable and interest income. We have taken the amount to be capitalized and amount to be shown in the, these are two different things, okay? These are two different things as such. These are two different things. This is amount to be capitalized and amount to be shown in the profit and loss account. Here what's happening? Dismantling cost. Okay, you can put like this. Okay, I will put one bracket like this, and I will put like this also. Same thing. Okay, dismantling cost, we have to take the interest factor also. Interest on dismantling cost. How much is there? Interest on dismantling cost is 94. Is it 94? 822. Fine. Now, this has to be shown in the balance sheet. This has to be shown in profit and loss account. Okay, this has to be shown in balance sheet. This has to be shown in the profit and loss account. Separately. Now, put one dash here. Put one dash here. Now, what we have to do? What we have to do? We have taken the interest. We have taken the dismantle cost. We are not going to take anything with respect to training expenses. Okay, we are not going to take anything with respect to training expenses. Now, what is the cost of property, plant and equipment? Step 3. Okay, step 3. Property, plant and equipment. Is it a property? What is the cost we have? Construction cost is how much? Construction cost is how much? Construction cost is 10 million. Okay, construction cost is 10 million. Next, interest pay, borrowing cost is how much? Borrowing cost. Okay, borrowing cost is how much? Step 2. Step 2. We have written their balance sheet. Is it how much is the borrowing cost? Borrowing cost is 510. Is it right? Borrowing cost is how much? 510. Step 2. Is right? Borrowing cost is how much? Borrowing cost is 510. Next, dismantling cost is how much? Present value of dismantle cost is how much? Present value of dismantle. Step 3. Is it? Present value of dismantle cost is 1580363. Total will be how much? 363090121. Is it right? This is the total cost of property, plant and equipment. Just under, now you can understand why we have done step 2 and step 3. Is it clear, Hussein, Sumaya and Mazin?
Clear, doctor.
Now,
Yes, clear.
what we have to do next from this? What they have to do? They are asking us what? They are asking us to do what? 30th September 2003. Is that they are asking us 30th September 2003. When they have completed this, completed is when? Completed is on when? 31st August 2003. Is it right? Now, from 31st August, they are asking us 30th September 2003. Is that 30th September 2003? They have used this asset for how many months? They have used it for 1 month. Is it right? They have used it for 1 month. When they have used it for 1 month, we have to calculate depreciation for 1 month. Understand point? This is completed. Is it right? This has been completed. Completed 31st August. Now, one month they have used it. Is it right? 1 month they have used it. We have to calculate depreciation. Is it right? Depreciation for 1 month. Is it depreciation for 1 month? How much is there? 12,090,363 times 1 by 12. It comes to how much? Yes, Hussein, how much it comes to? Very quick. I'm depending on you. Yes, Mazin.
10 million?
No, dear. 12 million 12,090,363.
1 million 7.
Huh?
36.
1 million 7. 530.
1 million 7.
530.
530.
10753. Check again.
Easy. Yes, correct.
Not 100. 1 million 7.
One 2,090,363.
363. into 1 divided by 12. 1, yeah, 1007530.
How much? How much?
Yes.
Now.
1007530.
Okay, fine. Okay, fine. Total cost of property, plant, equipment is how much? 120906363. Is it right? This is what is the life of this asset? What is the life of this asset? What is the life of this asset? How many years?
10 years.
It is for how many years?
10 years.
It is for 10 years. Is it right? We have used it for how much?
1 month.
1 month. Okay, we have used it for how much? 1 month. Then what is the value we will get? One two zero nine zero six three zero divided by 10 years into 1.1 divided by 2. 12.
1000753.
100753. Are you okay with this?
53. Yes.
Is it right? Slowly we have to take life. Is it right? Life is how much? 10 years. Is it right? Life is 10 years. This is the cost for, we have to calculating cost depreciation for only 1 month. We are calculating depreciation only for 1 month. Is it okay? Now, what is the carrying amount? Carrying amount is how much? Cost is how much? Cost is 100,90363. Okay. Depreciation for how much? Depreciation for 1 month. Is it depreciation for 1 month? How much? 100753.
1000753.
How much you will get?
13090 minus 10753. 129896.
1 2 or 1 1?
I said it's here in chat.
Huh?
I said it in chat. 11 million.
11 million.
082 832.75.
No, 120903363 minus 100,753.
129896.
1198610. Check again.
1209.
Is it at 1198610?
Yeah, correct.
Okay?
Yeah.
Fine. This is, see, this is a complete, this account 6 marks in the examination. Okay? This is the last question. Every chapter last question will be very, very comprehensive. Okay? Now, what we have to do, we have to show the statement of profit or loss. Is it extract? Is it a statement of profit and loss? Extract. 30th September 2003. Okay. Now, how much we have calculated depreciation? Depreciation, how much you have calculated? Depreciation step 3. How much you have calculated? 100,753. Is it there?
Yeah.
Fine. Now, we have finance cost. We have calculated how much? Interest. Is it right? Interest we have
510.
calculated. Interest or finance cost.
510.
Interest or finance cost. How much we have calculated in step 2 also calculated, in step 1 also we have calculated. Is it right? In step 1 also we have calculated, in step 2 also we have calculated. Is it? This is profit and loss account. Is it right? How much is there? 50,000 is there. 50,000. I will write separately. Is it right? Step 2. How much? 50,000. Is it right? Step 2, 50,000. Step 3 is how much?
10.
Step 3 is how much? Dismantling cost. Interest is there. Now we have calculated interest. How much we have calculated interest on dismantling cost? 94. It is there. It is there. 94,822.
Yes.
Is it there? 94,822. Step 3, okay? Dismantling cost. Is it? Dismantling cost. Interest, okay? Interest on dismantling cost. How much is there? 94,822. Total it comes to how much? 144,822. Understand my point? Step 2 and step 3. Next, profit and loss account. Okay, profit and loss account. You have the training cost is there. Is it right? They have the training cost. How much they have spent on training expenses? How much they
800.
have spent on training expenses?
800.
800 or 600? It is 600. Is it right?
600. 600. Yes.
It is 600. Is that we are where we are showing? We are showing in the profit and loss account. Is it right? Recruitment and training. How much? 600. Okay, recruitment and training. This much we have to show. Is it right? What we are showing? The statement of in profit and loss account, we show depreciation, step 3. We show interest, finance cost, step 2. We show interest on dismantling, step 3. Then we show, that's all. Okay, this is with respect to what? This is with respect to profit and loss account. Now, statement of financial position. Statement of financial position. What we are going to show? How much is the property, plant and equipment? Property, plant and equipment. Step 3. How much is the value? Tell me. 11,989,610. It is there. It is there.
Yes, doctor.
Fine. Now, next. Is that this is what this is? Now, non-current liabilities. Is it right? We have taken loan. Is it right? We have taken loan. Non-current liabilities. How much you have taken loan? Loan. How much? 6% loan. How much is there? 10 million. It is there. We have taken 6% loan, 10 million. Is it there?
Yes, doctor.
I am waiting for your response. Anyone should respond. I am waiting for your response. Is it right? Now, there is a dismantling cost. Is it right? There is a we have to pay dismantling cost to be paid in future. Is it right? This to be paid. Is it right? How much is the dismantling cost? Dismantling cost is how much we have calculated. Where when we have calculated step 3. Is that dismantling cost? How much we have calculated? 1580363. Okay, 1580363 plus we have calculated interest also. Is that we have not? Is that we have calculated interest also? Is it right? See what happening? Interest on dismantling cost. Is that interest on dismantling cost is how much? 94,822. This has to be paid. Is it right? In other terms, it is outstanding. Is it right? It is outstanding. This is not outstanding. Finance cost is not outstanding. Only the dismantling cost we will pay. Is it right? We will pay. We are making what? We are making provision. Little bit we need some more revision. Understand point? I know where you need some more revision. I will tell you in advance. Next time we are going to cover this point. I will make it more clarity. It is not going to understand by one time. Okay? Interest on dismantling cost. Is that interest on? Because this is outstanding. Is it right? How much it is? It is nothing but 94,822. Add it, how much you will get? One 1580363 plus 94,822. You have to be fast with calculator, my dear. 1675185. Okay, 1675185. Okay, this much you have to do. I know, I am telling you before, I am telling